We haven't started. We're going to go live on Facebook.
Oh,
they'll tell us.
Okay. Thank you.
Yeah, the technicians will tell us.
Wow.
You're right. Live now. Yes.
Good evening, everyone. My name is Helen Lurie, and I will be one of your moderators for tonight's event. On behalf of the Treasure Coast, Florida chapter of the Lynx, we welcome and thank you for joining us. We have partnered with Truist Bank, also known as BB&T, and SunTrust to deliver this evening's masterclass on home ownership and mortgage lending, which is part of our Healthy Homestead program entitled Discovering the Treasures of Home Ownership. Next slide, please.
Please give us one moment.
So we launched this program back in November because we saw the need in the community, and we wanted to make it our mission to assist our community the way that we could. We wanted to provide participants with information about credit, about the loopholes of purchasing a home, the obstacles that they may have to go through. And we just partnered up with a lot of professionals in the community in order to ensure that if we had participants that were interested in purchasing a home, they had the tools necessary to get there. So this evening is going to be a treat. For those of you that have been with us along the way, we say welcome back. Those of you that are joining us for the first time, we say sit back, relax, it's going to be a treat. On the screen, you will see myself, like I said, Helen Lurie, and our other moderator for this evening, Ms. Tanya Lowe. Next slide, please. So before we get started, I just want to share some tips for our successful webinar. Want to let you know that this webinar is being recorded. We ask that each participant stay muted. However, if you do have any questions, you will have the opportunity to type your questions in the chat. And those questions will be answered in the Q&A session that will follow the presentation. Next slide, please. At this time, what you should see on your screen is a pre-webinar evaluation, a QR code. And we're going to ask everyone to just take out your device, hold it to the QR code until your device recognizes it, then tap the notification to open the link. And you will have an opportunity to just answer some questions. What we're doing here is just kind of testing your knowledge before you start. What we have found is that there are many people that are confused, sometimes overwhelmed by the home buying process. And we wanted to test your knowledge before this information is in fact presented to you by our amazing presenters this evening. So I'm going to give everybody a moment to just, like I said, hold your device to the QR code, and there should be a series of questions where you can answer. And as you complete this, if you would be so kind to just type in the chat for me, done, or a thumbs up, it'll give me an indication that we are good to move forward. All right. See a couple in there. Thank you so much for completing that. I'm going to give you guys a little bit more time. So just a thumbs up, a yes, a done. If you're having issues accessing the survey with your QR code, there is a SurveyMonkey link listed on the bottom of the screen. I know that may take a little bit more time for you to type that in, but this information is very important, and we really want to capture and see what you know We hope to provide you with so much information and knowledge this evening that by the end of the day, at the end of the webinar, you will be a master in this topic. Do we have anyone else that's having issues accessing this or have completed? I'm watching the chat, so just let me know. All right, I got it. I'm getting thumbs up. Okay. So I just want to give you a little bit more information, which will allow you just another minute or so to complete it if you have not completed it yet. Why we launched this program, we saw the need in our community. We saw the need to increase home buyers in our community. And then we had to research, well, what were the obstacles? What's keeping individuals from being homeowners? And what we realized were some people had issues with credit. So we brought in a credit expert in one of our master classes. Some people didn't understand the home buying process. So that's why we have our mortgage lender. We have our just other different professionals within the field that have been joining us to assist us in providing that information to you all. So at this time, it looks like I have gotten quite a few responses. We will be moving on. Next slide, please. At this time, I want to take this opportunity to introduce to you Dr. Wilhelmina Lewis-Lyons, who is the Vice President of Programs. And Dr. Wilhelmina, floor is yours.
Good evening, Helen. Good evening, everyone, and thank you again so much for taking the time to join us for this incredible master class. It is my honor to welcome you tonight on behalf of our president, Attorney Phyllis Gillespie, and the women of the Treasure Coast, Florida chapter of the Links Incorporated. The Links Incorporated is an international not-for-profit corporation established in 1946. Our membership consists of more than 16,000 professional women of African descent in 292 chapters located in 41 states, the District of Columbia, the Commonwealth of the Bahamas, and the United Kingdom. It is one of the nation's oldest and largest volunteer service organizations of extraordinary women who are committed to enriching, sustaining, and ensuring the cultural and economic survival of African Americans and other persons of African ancestry. Our core values are friendship, integrity, honesty, service, commitment, family relationships, courage, respect for self and others, legacy, confidentiality, responsibility, and accountability. Links members contribute more than 1 million documented hours of community service annually, strengthening their communities and enhancing the nation. The organization is the recipient of awards from the UN Association of New York and the Leon H. Sullivan Foundation for its premier programs. In 2019, the Links Incorporated was nominated for a Luxembourg Peace Prize and recognized by the late Congressman John Lewis as a distinguished organization of outstanding community service and influence. The outstanding programs of the Links Incorporated has 5 facets, which include services to youth, the arts, national trends and services, international trends and services, and health and human services. Tonight's program is a result of incredible work led by our chapter's National Trends and Services facet. Therefore, I'm honored to introduce to you the facet chair, Dr. Elizabeth Jackson.
Thank you, Dr. Wilhelmina Lewis-Lyons, for letting us know who we are and what we do. It is my pleasure to introduce the Southern Area Chair of the National Trends and Services facet, Denise Cooper Esquire. Let me tell you a little bit about this phenomenal woman. Attorney Denise is a member of the Savannah, Georgia chapter, and she has been a member of the Links Incorporated for 15 years. She also is an AeroLink. She's a Scott Hawkins Fellow, Cohort 3. She has served the Links Incorporated and her local chapter in the following areas: She has served as the Southern Area National Transit Services Chair. She was Area Program Chair and Legislative Issues, Public Affairs, and Disaster Relief Chair. In the local level, in her chapter, she has served in many various leadership positions, including Program Chair and Vice President. And of course, as I previously stated, she is now serving as the Southern Area National Transit Services Facet Chair. Professionally, Attorney Denise serves as an Assistant City Attorney for the City of Savannah. And so to bring us greetings, Southern Area style, is the National Transit Services Facet Chair, Denise Cooper, Esquire. Welcome.
Well, good evening. Good evening. Thank you all for having me. I want to acknowledge your president and vice president and all the leaders here today. I appreciate you inviting me. You all have started a wonderful series, and on behalf of our Southern Area Director, Sylvia Carter-Perry, and our Program Director, Deborah Thomas for the area, we're excited that you all have continued the charge of Healthy Homestead. And how important is this topic? We were chatting before starting about how the new members actually were ahead of their times in planning something around home ownership and the support for women and children and new homeowners, period. That is a gap in our community, and we are intending to fill that. So with our Healthy Homestead Initiative, that is just what it's been. We have partnered now with Truist, who hasn't finished their official collaboration yet, but we still go by Truist, and we have our Truist grant and representatives here. And so we're excited about that partnership to allow funding to our chapters, continuing to foster this effort of home ownership and that journey to home ownership. Not that it's just at the end, but where does it begin with savings and budgeting and planning and all the types of things that require for preparation to get to that ultimate goal. And then of course, going beyond that. You know, maybe this is not the only home, and how do you pass that down to your children? So thank you again for the opportunity to join you this evening. This is an exciting program. I love to see that it continues. It started before tonight and will continue more into a series, because all of these topics require in-depth conversation. And so sometimes you just can't get in that 1 hour. It allows you to bring in other partners and other information, because that's what transformational programming is about. It's about the longevity, and it's about building. And so the one-time event is not, we know that's not programming, and you all are doing a fantastic job in Treasure Coast, and I congratulate you. So again, thank you for having me. I'm excited about your continued program and serving your local community. Thank you.
Thank you so much. On behalf of our chapter president, she also is an attorney, and so she's running a little late, but she will be on, and she wanted to make sure that we extended her to let you know that that you would understand the work of an attorney. Thank you so much. And now Helen our Tanya.
Thank you so much, Dr. Jackson. Good evening, everyone. And again, welcome to our program this evening. We have some exciting information to share with you this evening. We have with us Mr. Richie Asensio. Richie is a member of the Truist team. He has over 20 years in the mortgage business, and he has helped many people achieve their goal of homeownership. He believes in turning the stressful mortgage loan process into a manageable and enjoyable one. More than that, Richie, as a community mortgage specialist, specializes in affordable home loan products and down payment assistance programs. He has a passion for helping and is looking forward to answering your questions this evening. The dream of homeownership can be a reality for you. Richie can help you achieve it. So please help me welcome Richie. Next slide.
Well, good evening, everybody, and thank you for that great introduction. Yeah, it's really, truly an honor to be here and, to hopefully help you achieve that dream, okay, and get you closer to that, to the dream of home ownership. With that said, we'll discuss today the part of the mortgage process. We'll talk about what that entails. We'll talk about the do's and don'ts, if you will. And I would also like to allow some time if you guys have questions, if if there's any concerns or any doubts that you may have, please use the chat box. We are monitoring that as well. And of course, feel free to jot down our contact information, and later on, if you have more questions, please feel free to ask, because that's what we're here for, to help. Okay, so if we jump right into the next slide. Okay, so let's start. Let's begin with the mortgage process. Okay, first of all, the mortgage process can be extremely intimidating. Everybody that around you has an opinion. Everybody is an expert, and everybody wants to tell you what their experience was like, what you should and should not do, and unfortunately, that all that information can be overwhelming. The truth is that when starting the mortgage process, the home buying process, if you will, the most important thing that the most important tool that you can have at your disposal is information. Okay, we always recommend as lenders that you shop around. Okay, and let me be clear about this. When I say shop around, I mean inquire with a couple of lenders. We usually recommend at least 3 different banks, starting with your own bank, of course, because normally you'll have a good relationship with somebody in the bank, and more than likely they know your situation a little better. Okay, but when you go and ask for information about the home buying process or mortgages, okay, make sure that you're asking for a general quote. Okay, information about what rates are like, what the mortgage process with them is like, and I say that because a lot of lenders out there, the first thing that they will do is try to get you to put in an application, and that requires pulling your credit report. And that is something that you have to guard. You have to be really careful about. Okay, so initially, start getting an idea of what rates are like in different institutions, and what the process is like, so that you can have that information on your site. Okay, another very important aspect of this is that to make sure that the lenders that you are talking to, that they're familiar with down payment assistance programs, that they're knowledgeable about the programs that you need in order for you to become a homeowner. And not every lender specializes in certain programs. Okay, not every lender has every program. So that's part of the process. Make sure that you're asking those questions, and make sure that they do participate. Next slide, please. Okay, so let's talk about the difference between mortgage lenders and mortgage brokers. Okay, and if we look at the left, so when we describe a mortgage lender, okay, the mortgage lender lends their own money. Okay, they basically have their own lines, and with a bank such as Truist, SunTrust, BB&T, they actually lend you money. Okay, then the process can get a little bit more complicated, and actually they'll sell the loans in the secondary market, but they keep the servicing, meaning that you're always paying to that lender from beginning to end. Okay, and they do that so they can recover the money again, so they can lend to other people. Okay, a mortgage lender will originate and service their own loan, which is basically, servicing the loan is basically where you actually go to that bank to make your payments. So you close a loan with SunTrust or BB&T or Chase or whichever bank, you're making your payments to them along the life of the loan. Okay, normally, because of this, the loan will actually cost less, meaning rates are going to be more competitive. Okay, a lot of times it's just going to be better terms all around, because the lender doesn't have to necessarily buy the money from another bank. okay? Um, Now, most lenders will work with down payment assistance programs. Having said that, most lenders will also have people that specialize in down payment assistance programs. Okay, and with us, I'll give you my example. As a community mortgage specialist, my job with the bank is actually to specialize in this type of programs. The reason being is because there's so many, intricate parts that you have to keep up with. Okay, there's a lot of different factors that need to be in place in order for this type of loan to work, that require more work, require more contact, and require certain knowledge of so many different programs that you basically need a specialist. Okay, so that's very important to know that the bank that you work with, they actually have the knowledge. A mortgage broker, on the other hand, okay, will actually lend other people's money, meaning that that institution actually has relationships with different lenders. Okay, so for example, ABC mortgage broker may be signed up with SunTrust. They may be signed up with uh, JP Morgan Chase. They may be signed up with a couple of different lenders that will offer products that they can actually sell. Okay, now with that said, the mortgage broker needs to make money, right? Because it's a business. So in order for them to facilitate a loan, they will actually charge you a bit of a higher rate, okay, so that they can get paid on the loan. Because of that, the pricing on a mortgage broker's loan may not be as competitive as a mortgage lender. Okay, since they don't lend their own money, 100% of the times they will actually sell the loan to the bank that they made the agreement with. And typically, they do not work with down payment assistance programs. Next slide, please. Okay. Now let's talk about who the mortgage loan professionals are. The purchase of a home requires a whole team of people working in sync, so that you can get to the closing table and you can actually become a homeowner. On the bank side, okay, you have the mortgage loan officer, and that is the person that actually has that initial conversation with you, answers your questions about how the process works, answers your questions about rates. They're actually licensed to speak about rates and those programs. The mortgage loan officer should be your right hand, okay? The person that you go to if you have any type of doubt as to the process, and the person that will actually educate you as to what works best for your particular situation. Okay, then when that loan officer gets, for example, you get a contract and you're starting the process, then the whole deal then passes over to a mortgage loan processor. The loan processor packages your information for approval. Basically, they're the people responsible for making sure that they collect all the documentation to prove the information that was inputted into the loan application by the loan officer. Okay, which in turn is the information that you as the client gave to the loan officer. The mortgage loan underwriter, okay, this person is extremely important. This person is the one that makes the decision on your particular loan. Now, to be clear with this, the mortgage loan underwriter doesn't just approve or deny loans depending on how they feel, right? It's not a matter of I'm not having a good day, I'm just not going to approve this loan, or I don't like the color of this paper, I don't know, I'm going to send it back. It doesn't work that way. The mortgage loan underwriter actually has a set of guidelines that the bank states of what we can and cannot do on a particular mortgage program. So for example, you may be applying for a mortgage that requires a down payment of 5%. Okay, just to throw out a number. So the mortgage loan underwriter, okay, make sure that on this particular loan, that 5% of down payment, okay, is coming from, say, for example, yourself, or maybe the program allows for that 5% to be a gift, or or it may allow to to have an organization give you the money as down payment assistance. So whatever happens with that money has to fall under the parameters of the particular program that is being used to fund your loan. And the mortgage underwriter is the one that makes that decision. They are the ones who actually will calculate and verify that the income that we stated on the application is correct. They will analyze, tax returns. They will analyze pay stubs. They will analyze your bank statements. In fact, everything that has to do with the loan, in order for them to make sure that that loan is safe for the bank to actually invest their money in. Because at the end of the day, basically they're responsible for the bank's money, and they're responsible to make sure that you as a client, okay, are getting a good loan product, okay, that will actually cover your needs. Now, once all the final decisions have been made on the loan and it's approved and we're ready for closing, the package goes to a mortgage loan closer. This person will put all the paperwork together, okay? And by this point, that file can be really thick. It can have a lot of documents, and they're responsible for making sure that everybody comes together: the title company, insurance company, the money from the bank, okay, the appraisal, that everybody, everybody that has contributed to that loan has all the paperwork, and everything is ready to go to the closing table. So the title company can actually, get the closing papers to you so that you can sign and you can actually have the keys to your home. Okay. Next slide, please. Okay. Very important. So, and if I'm not mistaken, this was one of the questions for the pretest, correct, Helen? Okay, so the difference between being pre-qualified and being pre-approved. When you're pre-qualified, a lender will base the affordability, okay, on buyer's information without verification. What that means is that a lender, a loan officer may ask you how much money you make, what your debt is. So, do you have any type of credit card debt? How much do you pay as a monthly payment on them? How much do you make? And what you think your credit is like, meaning what score, if you've had anything major in your credit. But they don't actually verify, by pulling a credit report, by actually looking at your pay stubs or anything like that. Based on the information that you give them, they will actually draft up a letter and say, hey, Mr. So-and-so has been pre-qualified for an amount of so much. You take that letter and you bring it to your realtor. And if no information out of that letter has been verified, okay, that paper really means nothing, because once you get to the approval process and the information is not accurate, okay, it may blow your whole deal up. A pre-approval, on the other hand, okay, it's a little bit more involved. So when you go through a pre-approval, you will actually give the information from an application to your loan officer, okay, and in turn they will actually verify the information by pulling a credit report, okay. Most will actually also take a look at your pay stubs, W-2s. If you're self-employed, they will look at your tax returns for the last couple of years, okay, and they will also verify where your assets are coming from, and ensure that you have sufficient assets to actually qualify for the mortgage. What that does for you is that when that letter of pre-approval gets drafted and you take it to, again, a realtor, okay? And that realtor shows it to a homeowner that you might be, a home that you might be interested in looking at. They can know that, first of all, you're actually serious about the process, okay? You have taken the first few steps to make sure that you can actually afford the house that you're looking at, okay? And of course, if you end up liking the home, then once you put a contract in it, as long as the information that you have provided is accurate, you will actually get to the closing table, because the lender has done, a bit more work to actually make sure that you do qualify for the program and the amount that you have approved for. Okay. And that's very important, because a lot of loan officers out there, okay, will want you to speak with them and actually give you a pre-qualification without taking the time to verify the information beforehand. Please make sure that, whenever you're going through this process, take the time to have the documentation, and we'll speak a little bit about that later on. But make sure that you're getting pre-approved. Okay. Always ask that question, if you're getting pre-qualified or pre-approved. And if you have any doubt, please feel free to ask somebody else, or clear it with the loan officer that you're speaking to make sure that you don't have any issues later on. Okay. Next slide, please. Excellent. So the most popular types of mortgage programs. Okay. First one, FHA, Federal Housing Administration. Okay. Basically, it's insured by the government. The FHA program is usually the easiest, the most flexible, if you will, for first-time home buyers, and therefore is favored by most first-time home buyers. It allows you to get into a home with a fairly low down payment. The minimum is 3.5%. Okay, and because they are insured by the federal government, the guidelines, okay, allow for some more flexibility than conventional loans. Which, by the way, this is another question that was on the pre-work. The next popular program would be veterans, okay, VA. Now, the Veterans Administration has a program that actually allows, excuse me, a veteran to go into a home with 0% down payment. Okay, so they will allow for 100% financing on that property. Another great aspect of that program is that it doesn't require mortgage insurance. So the payments that are actually being made into that loan go directly into principal, interest, and of course your taxes and your homeowner's insurance, but no additional payments there. There is a couple of different requirements with VA. So, for example, you need to, excuse me, you need to make sure that you provide the form DD 214, okay, which at the same time it allows you to use the program particularly. Let's see, the conventional program. That's the most popular, Fannie Mae, Freddie Mac. That's what you hear most of the time out there in the streets, if you will. And they have programs that allow you to get into a home with as little as 3%. And of course, the most popular with conventional programs is when you have a 20% down payment. Okay, and the reason for that is because at 20%, you don't have to pay private mortgage insurance. Now, private mortgage insurance is a type of insurance that is placed on the loan, okay, as a protection to the lender when a client doesn't have 20% to put down. Okay, so it's been determined that when a client has at least 20% down into the transaction, they're less likely to walk away from it that easily, and the transaction is just more secure, if you will, when you're looking at it from a risk standpoint. Okay. Now, with that said, the conventional program, when you have a low down payment, for example, 3%, 5%, because they're not insured by the government, they are actually less flexible. They're riskier programs for the bank, therefore usually may have a bit higher rate, and the guidelines will be more strict. Okay, that's not to say that you couldn't get a conventional loan for your home if you have less than 20% down. It's just that the requirements may be a little bit more stringent than, for example, FHA. Now, with FHA, even though you can get into your home, fairly easily with just 3.5% down, one of the downsides is that you will pay a mortgage insurance premium through the life of the loan. Unfortunately, a mortgage insurance premium or a private mortgage insurance on the conventional side really doesn't benefit you at all. It's there more for the protection of the lender. So we always try to find ways to avoid having to pay private mortgage insurance or the mortgage insurance premium if at all possible. However, if that's the only way that we can actually get you into your home, okay, please don't let that be a deterrent, because at the end of the day, that's going to be the biggest investment, more than likely that you'll make. And you want to make sure that you're getting into your home and not paying rent and making somebody else rich. Okay. So, of course, if you have more questions about that, we can definitely, talk about it later on. And I'll be glad to answer any additional questions on that. Okay. So next slide, please. All right. So this is important. Documents needed for loan application. Now, it all starts, of course, with the mortgage loan application, where you actually fill in all the information, and these documents are all to supplement and to verify the information that you actually provided for the loan application. So, of course, at some point we're going to need a contract. So signed by all the parties, the sellers, and of course, the buyers. And that is the actual document that puts all the loan in motion. Okay, up to that point, everything else has been about verifying your income, your credit. But when you actually have a property, that's when everybody starts getting involved. The loan underwriters, the processors, the closers. So that's when things get exciting, if you will. Please keep in mind that the bank will always verify the last 30 days worth of pay stubs. That means that if we start the process and it takes us a month and a half, 2 months to actually find a property, okay, every couple of weeks, every time while you're in that process, every time that you get a new pay stub, go ahead and upload it, or make sure that the loan officer has the latest one. Okay, the newest documentation is going to be the one that actually matters. Okay, so if you get paid twice a month, then we're going to need the last two. If you get paid monthly, then we just need one. So as long as we have the last 30 days worth of pay stubs, that's really what matters there. If you're employed by a company, okay, if you're an employee, say for example of Target, Walmart, anybody that actually takes out taxes out of your paycheck, okay, we will require the last 2 years W-2s, okay, not the tax returns, just the W-2s. And those are the little forms that you get at the end of the year, so that you can do your taxes. Now, if you're self-employed, okay, the bank will require the last 2 years of tax returns, all pages, okay? And with self-employment, what the banks are going to be looking for is the adjusted gross income. So what that means is that they're going to look at your income after you've had all your losses. And that's very important, okay? Because day in and day out, you know, I deal with clients that really make good money, okay? But when it comes time to taxes, you know, they'll go to their accountant, and their accountant will actually create a lot of losses in their tax in your taxes, you know, just to avoid paying taxes. Unfortunately, happens. The way to think about income when it comes down to your, you know, to your tax returns is, you know, either you're getting a refund, okay, and showing no money, or you're paying taxes and actually showing income. So it's either one. And if you're in the home buying process, okay, you're going to need to show that you're actually making a profit, that you're making money. And with tax returns, we're going to average out the last 24 months. So in this case, we will look at 2019 and 2020. Okay. And, you know, the bank will look for consistency in income. They will also make sure that, you know, of course, the money that you're making, you know, makes sense for the line of work that you're in. We will also ask for a current profit and loss statement, okay? And that will not count towards your income, but it will show that your business is still running, that you're producing, and that you're, you know, on par with at least, you know, the previous year. In other words, that you're not declining in terms of income. Okay. Now, if you receive Social Security or retirement or a pension, okay, we will require the latest, the most recent award letter. So for example, Social Security, we're gonna need the award letter. If you have a pension, any type of documentation that you have that actually, you know, shows how much you're getting, okay, we're gonna need. And a lot of times, you know, those documents, we either don't have them at hand, or they might be a little bit difficult to get, because you might need to contact the company. You know, it could be a number of things that you might have to jump through a couple of hoops, okay? But know that we're gonna need them. So, you know, plan accordingly, and make sure that we can get those documents, because at some point, the bank is gonna require them. If you have any type of, you know, other income, such as child support, alimony, okay, you know, have court documents, have, you know, divorce decrees, have any type of documentation proving that you're entitled to get that money. Now, with that said, you're not required to disclose, okay, or use that particular income to qualify, okay. But you are more than welcome to. If you need, you know, if you need it, and you're okay with disclosing it, then we'll, you know, we'll gladly use it, okay. Another thing is, we're gonna need the last 2 months bank statements, okay. And when I say the last 2 months, I mean all pages, including blank pages. So every page in that in that comes to you in that bank statement, okay, we're gonna want it. And I say that because a lot of times, you know, a lot of our clients will leave out, you know, the page in the back that says this page was left intentionally blank. Well, it doesn't have anything, right? So why bother? Well, fact is that we want to make sure that every page that is in there is shown, so that we can verify that there's no other transaction that was left that we don't see, okay, just to make sure that everything is up to par and that everything makes sense on the with the bank statements. If you have a 401k, okay, a 401k actually helps you quite a bit, because, you know, something that a lot of clients don't think about is that when we're looking at the whole transaction, okay, every asset that you have is going to help show stability, okay. if we think of a typical client, you may have a car payment, you may have, or two, you may have a bunch of credit card payments, right? But yet in the bank, we may not have a lot of funds. We may not have a lot of money in savings. If you had, for example, if you had a 401k from a company that you've been with for years and years, that actually, even though you may not need to use it for the transaction, okay, it shows that you have certain assets, okay? And that gives your file strength. And believe it or not, that can make a difference. So, any type of document, any type of, my apologies, any type of asset that you may have, maybe you have an investment account, maybe you have an IRA, or 401k from a company that you worked with 20 years ago and you never bothered to touch it, okay? All of that documentation, make sure that you share it with your loan officer. The more the more that you give them, the more information that you give your loan officer, the easier it's going to be, for your loan officer to help you, get that loan. Okay. If you're a veteran and you're doing a VA loan, you're definitely going to need, like I said before, the DD 214, okay, which is the certificate of eligibility. If you've had a bankruptcy, okay, please make sure that you disclose it. And I say that because there's been a trend in the last few years where clients will visit credit repair companies, right? And all this type of accounts get deleted. Well, guess what? Even if a bankruptcy doesn't necessarily show in your credit report, okay, the bank will find out. So you're better off disclosing it up front. Okay, the last thing that you want to do is have your bank, find out about a situation such as a bankruptcy, and find it out from their systems and not from you. Okay, so we definitely want to be upfront with all of that. Now, if you've had a bankruptcy, please make sure that you have all the documentation for the bankruptcy. If you say it, if you tell your loan officer up front, okay, they will actually keep it in mind and ensure that the program that they're running you through actually qualifies for the, depending on how long you've had that bankruptcy or how long has it, it's been discharged, okay? If you've had a divorce or a separation, we're also gonna need that documentation. And that documentation is extremely important. Being a community state, okay, if you are still legally married, even though you're separated, okay, maybe you went your separate ways years ago, and you never went through a divorce, or you started the process and never finished it. At that point, if you buy a property, okay, the other person has to sign. And if you don't know where they are, well, guess what? It becomes a mess. Okay. So definitely, make sure that type of documentation is in place. And of course, if you've had a divorce and you have any type of documentation like that, present that to your loan officer. Okay. Next slide, please. Okay. So information needed for a loan application. It is extremely important to document the last 2 years of rental history, okay? And when we say that, we also need to include the landlord's information, because we will verify that information with them. And that's important because since you're purchasing a home, we want to see what your discipline, if you will, what your history is of making payments in your dwelling for the last 2 years. Name, address, telephone number of employers, okay? And again, for the last 2 years, 24 months. We want to make sure that we're able to contact, whoever your employer is worth in the last 2 years, so that we can establish your work history. When you provide that information, if you know the HR or payroll contact information, please provide it as well. Okay, it'll make it a lot easier. The easier that you make it for the loan officer or the loan processor to actually verify that information, the faster your loan can go through the system, and the easier it's going to be for you to get to the closing table. If you have or own any real estate, okay, make sure you disclose that anywhere, okay, and make sure you have, of course, all the information, address, and of course, location. And if you have any type of debt in that property, that needs to be disclosed as well, as you know, that needs to be taken into consideration. Okay, and of course, any other financial documentation is needed. For example, if we've had a collection and you paid it, okay, in full, you need to have that documentation handy, because the credit report may not be accurate. It may not show that you actually paid a collection, or that you came to an agreement with that company, into a payment plan. So you would need to make sure that it's up to you to make sure that information, is in our hands, so that we can, make the right decision. Okay. And of course, any type of letter or explanation, excuse me. So for example, like I said before, if we had a bankruptcy, if we've had a foreclosure, if we've had any type of short sale, anything in the past like that, okay. If we had a discrepancy if we had a name change, for example, okay, things like that, they may require a letter of explanation. So, make sure that you have it handy, so that we can put it into the file and explain any type of inconsistency, just to make the process a lot easier. Okay. Are there any questions up to now?
No questions yet in the chat box.
Okay.
But
okay.
While you're on the subject of bankruptcy,
Mhm.
how long after bankruptcy can you apply for a mortgage?
That is an excellent question. So the minimum that you will have to wait is 24 months. So with FHA, after 2 years, you can actually apply for a mortgage. Okay. And when we're talking about 2 years, we're talking about from the discharge of the bankruptcy. Okay. And again, at the initial interview, if you've had a bankruptcy, disclose that to the loan officer. Okay. The loan officer will ask you for that documentation, and make a determination from there. But normally the minimum is a couple of years.
Okay. And the same apply for short sale and foreclosure?
No. So short sales and foreclosures, we're talking a minimum of 36 months. Okay. So if we've had a foreclosure or a short sale, the minimum is 36 months. And it's important to know that with that type of transaction, okay, it's 36 months from the recorded date. So not from the date that say, for example, that the loan was went bad, but from the day that the property was actually signed over to the either to the bank, or if it was sold to the next owner.
Okay.
And sometimes there's a lag of time there, and it could be significant. Excuse me. So there have been people that have gone through a foreclosure. Okay. And they may come to me and say, well, I had a foreclosure 3 years ago, but the house actually sat there for 6 months and there was no transfer of title. So actually they've only had the foreclosure for 2.5 years. You see, so it can get a little bit complicated, and that's where the documentation comes in really handy.
Okay. Thank you there, Rich. And someone would like to expand on which credit report or credit score is used during the mortgage process.
Excellent. Yes, and that's actually, excuse me, a great question. So we utilize TransUnion, Equifax, and Experian. Okay, and so it's what we call a tri-merge. We'll look at all 3 credit bureaus, okay? And for the purposes of scoring, okay, we will go with the middle of the 3. So for example, let's say that in one of the bureaus you have a 650, and another bureau you have a 620, and in another bureau you have a 700. Your middle score is going to be your 650. So we'll take the middle of the 3, not the average, but the middle, the middle of the 3 scores. And excuse me, if a loan has more than one borrower, so in the instances of husband and wife, for example, okay, the lowest of the 2 middle scores is the one that it's going to be used for the program. Does that answer the question?
I think so, yes. But
Okay.
do you require a minimum credit score to be pre-qualified or pre-approved for a mortgage? What's the minimum credit score to get an FHA?
So yes, so the minimum for FHA currently is 620. Okay, in the industry. So, but for example, right now, due to COVID, okay, our minimum in Truist is 640. You see, but there are banks that will allow down to a 620 right now. And we also have programs. I mean, we also have programs that we'll start at 620, okay, and allow a client to actually get their mortgage through a conventional program. Okay, so yeah, the minimum is 620. My apologies.
Okay, thank you there.
You're
and
welcome.
also, I just have one more regarding for any veterans that may be in the meeting.
Mhm.
Do we have a minimum credit score for veterans?
So yes, for veterans, for the VA program itself is 640.
640, okay.
Mhm.
And
well, we're talking about scores, Don. You know what? I want to mention something that has become a trend. A lot of us, are familiar with Credit Karma. Okay, scores in credit monitoring apps, okay, are not necessarily accurate for mortgage purposes. Okay, it's not uncommon for the scores in Credit Karma to reflect points of 40 to 60 points higher than what the actual scores are. Okay, the reason for that is that, and I'll refer again to Credit Karma. Credit Karma is owned by TransUnion, and they utilize those scores. The bureaus that are used more for credit cards and personal loans and that type of deal. Okay, and therefore they're not necessarily the same scores that a bank will use for a mortgage process. Okay, so it's important to know, just so that there's not a shock if you see your score at a certain a point with one of those apps, and yet when we pull it, it's totally different. Okay.
And that's very good point, Richie. And as I love to caution my clients, because I also use Credit Karma as a guide. It's only a guide.
It's only a guide. Correct.
It's only a guide, and it's a good tool to have. So at least if someone pull your credit, new accounts, then at least you'll get that alert. But it's only a guide. Right. The only time you will get a true credit is when a bank pull, when a financial institution pull your credit, then that's when you get a true credit, or possible going to the free annual credit report.com where you pay for that.
That is correct. That is correct. And that's you said it perfectly. It's a great tool. Okay, it's good to have, and it's good to actually monitor your credit, because you never know when you have identity theft. Okay, it happens, and you'll only know if you're keeping an eye on your credit reports. Okay, so just like I said, just don't rely strictly on those scores for your mortgage transactions, if you will.
Thank you.
Oh my God, my pleasure. All right. Can we go to the next slide, please? Good deal. Okay. So the mortgage loan process. First things first, the mortgage loan process can take anywhere from 30, I want to say 30 to 90 days. Okay. Typically, guys, the process takes 30 to 45 days. Okay. However, why do I have it there as 90 days? Well, here's the thing. so when you apply for a mortgage, okay, you have to be on top of this, okay. And a lot of times, we'll take for granted that the clock is running, okay. If your loan officer asks you for documentation, okay, and they ask you for an updated pay stub, for example, okay, we need it yesterday. If you sit there and wait a week to get that pay stub, okay, or that letter of explanation, or anything like that, okay, the longer that you take, the longer that the whole process will take. If the information in the application is not accurate, okay, it may take a while for us to kind of put it together, because if the underwriter cannot verify the information right away, they'll suspend the file and put it to the side. Okay, please understand that they're looking at hundreds of files, so they cannot afford to just sit there and try to figure out things. So they'll suspend it, they'll put it to the side and wait for the loan officer and the client to actually get their act together, if you will. Okay, so the process can be delayed. Now, if you're using down payment assistance, you have to go through the program to actually get approved through maybe sometimes even another institution, okay, for the funds to get approved and be applied to your mortgage. That takes time. So the process is long. It doesn't take 3 to 5 days, which, as a matter of fact, is another question of the pre-work, right? So be prepared, okay, to hurry up and wait, if you will. It's always going to take longer than we want, okay. But the one thing is that if you have all your documentation straight, okay, and you are proactive, we can get your loan closed, fairly quickly. But it it is a process. We have appraisers that have to go out there and appraise a house, home inspectors. And by the way, always get a home inspection. It may not be required by the bank, but it's the best, $300-400 that you can spend, so that you don't have any surprises, 2 years down the road after you have closed in your home. Okay. Within 3 days of application, you will receive initial disclosures. Okay. And be on the lookout for those disclosures. Really, you should have good communication with your mortgage loan officer, and they can tell you what to expect. Normally, nowadays with technology, this initial disclosures will be sent to you electronically. You e-sign them, okay, and send them back to the lender, and that's that. Okay. In that paperwork, okay, you'll have a document called intent to proceed. It is extremely important that document actually gets filled out, because you have to tell the bank that you are intending to proceed. Now, that particular document also has a space where you will actually fill out the financial information, so that the appraisal can actually be charged to to a card or a bank account. Okay, because out of all the charges on a mortgage transaction, the appraisal gets paid up front. It's calculated in your numbers, okay? It's part of your closing costs, but you pay it up front, so that the appraiser can go out there and make sure that the house value is actually there. Okay. Now, once you turn that into the lender, the intent to proceed and the rest of the initial disclosures, your loan can actually be set up and continue to processing and underwriting. Okay. Once the fees are received, the appraisal, will be ordered. And of course, title work will begin. And this is where all this, different pieces start coming together, where, the whole team with the title company and the insurance company, the appraisers, everybody putting their information together so that we can get you to the closing table. Your file is reviewed by the underwriter, and they will provide a list of conditions. If we provide a very clean file, there may not be, but one or two conditions. Hey, we need to update a pay stub. We need to make sure that we have the latest bank statement. If a file's a little bit more complicated, then you might need to, the underwriter may ask for letters of explanations. They may ask for proof of funds from, strange deposits on the accounts and things like that. Okay. And then, of course, the loan processor and the loan officer will work with you to make sure that, that we gather those conditions. Next slide, please. Okay, so we'll verify your credit, your rental history, your employment and income, okay? And again, with employment and income, it's very important that you're honest with your loan officer and that everything, is verifiable, okay? Your savings and all your assets. And we'll also verify the affordability. In other words, to make sure that the loan that we're giving you makes sense for you, okay? Let me explain. There's such a thing as payment shock, okay? Where you may be currently paying $900 on your rent. And that would be beautiful because rents are through the roof right now. But okay, so you're paying $900 for rent. And the new mortgage, even though you can afford it, is $1,800. Well, that's double what you're paying now. So that's a shock. And that's something that needs to be looked at, very closely to make sure that it doesn't become an issue later on. So, all those things are going to be studied and looked at by your underwriter, and your loan processor will make sure that all of that is together. Okay. The loan processor will gather all these conditions, package them up nicely, and present them back to the underwriter to clear and get a final so that we can take your loan to the closing department. Next slide, please. Okay. Be certain that you do the following. You keep all your accounts current by paying on time. Okay. Make sure that your credit card payments are not late. Your car payments are not late. That your rent is not late. Make sure that everything that you're paying it actually stays on time. Make sure that you keep copies of your pay stubs and back statements, because you are going to need to update that with the loan officer and the processor. Make sure that you keep receipts for all credit accounts for proof of payment. So if you have paid off a car, okay, but it's still showing on credit, I need that documentation. I need you to make sure that you have the documentation proving that you paid it off, because otherwise we still have to count it in your debt to income ratio since it shows up on your credit. Okay. Give the lenders, of course, copies of all the documentation quickly, and stay in close contact with your loan officer. Your loan officer has to become your best friend through all this process. Okay. Don't be afraid to pick up the phone and call them and ask them questions, and make sure that you're both in the same page. Next slide, please. Oh, don'ts. Okay, this one's a biggie. So be certain that you don't apply for new credit. Okay. God knows that I've had many cases that have fallen apart at the closing table, okay, or right before the closing table, because the client got excited that they were going to go close on their mortgage, and they went and bought a new car. Or they went and spent $6,000 in rooms to go, and they put it on a credit card because, they need to furnish their new home, not realizing that the bank will find out right away. And the debt to income ratio was at the limit, and one more penny in debt would throw off the loan. Okay. You know how heartbreaking it is to tell a client that is excited about moving that they can no longer qualify for a loan? That is the worst feeling in the world. So, please make sure that once you start the mortgage process, credit is sacred. You do not allow anybody to pull your credit. You don't get any new credit accounts. You go to Walmart and they tell you they're going to give you the grocery shopping for free if you apply for an account. No, thank you. I'm going to pay for it. Okay. But you do not let anybody look at your credit. No debt. Now, once you have your keys and you've walked away from there, that's on you. Okay. Of course, you got to make sure that you don't get into too much debt, because then you might have a hard time down the road, paying your mortgage, and you don't want that. But while in that process, protect your credit and your debt. Okay. Please don't quit your job. Please don't change jobs. Don't do anything like that, because it could throw off the stability of the file. Okay. And it could end up, costing you the ability to close. Try not to change bank accounts. Okay. Try not to close. Definitely don't close any credit cards. Okay. There's a big difference between paying off a credit card and bringing it down to zero and actually closing it. Okay. You can bring it down to zero, and of course, discuss this with your loan officer before doing anything. But you could actually bring an account down to zero, and that's okay. But not necessarily close it. You close a credit card because you never use it. That limits your credit availability, which means that if that credit has to be repulled for whatever reason, your credit score could be lowered drastically. Okay. And that could hinder your chances of getting that mortgage. Don't make large deposits. Okay. You have $5,000 sitting at home and you decide that you're going to deposit that money, a week before the closing. That could throw off your closing as well. Okay. Because any type of large deposits or unexplained cash deposits into your bank account will actually bring a level of doubt into the transaction, because we don't know, we have no way of verifying. There's no paper trail into that transaction. So it could jeopardize your chances. Okay. So please don't do that. And of course, don't lie to the mortgage company. Okay. It's in this presentation for a reason, guys. Okay. Sometimes we think that if we don't tell the whole story, it's okay, they're never going to know. Well, like I said at the beginning, the worst thing that you can do is have the mortgage company find out something about your situation that was important, that was, a material fact, and it wasn't disclosed by you. Okay. This is a business of integrity, and we got to make sure that we're honest with each other, basically. Okay. Next slide, please. Mortgage rejection. So your mortgage may be rejected because of insufficient documentation. So if you do not provide the documentation required, okay, in order to prove everything that was told in the application, your loan could be rejected. If your loan just doesn't fit the program guidelines, okay, it may not happen. Now, that particular point, okay, is the reason why I said in the beginning that it is important that the bank that you're dealing with understands the program that you're using. So if you're using a down payment assistance program, you need to make sure that the bank that you're working with understands how to work with that program. So that way they don't, create an issue for you where you wouldn't be able to actually comply with the guidelines and not be able to qualify. Okay. It may get rejected if you don't have the acceptable credit. So if a particular program requires a minimum of 620 and your credit comes up to 619, it will not work. Okay. Something like that happens, please make sure that you ask a follow-up question. And that follow-up question would be, Mr. Loan Officer, what do I need to do to get there? Okay. So for me, and in my career, I have always, taken the time to speak to my client and actually let them know, listen, if you don't qualify now, okay, if this can't happen at this point, okay, I'm not going to leave you there. This is what you have to do in order for you to become a homeowner. And sometimes it takes years. Okay. The only thing that I cannot guarantee you is the time. But I can guarantee you that if you follow the steps, okay, and if you're serious about your particular situation, okay, and you're willing to make the changes needed, you can become a homeowner. You can get your credit up, and has nothing to do with credit repair or lying to the companies. None of that. Okay, so it's a matter of having the right information at your disposal. Okay, if you have an unacceptable rent history, that could hurt you. If your debt is out of place, okay, if for example, for most mortgage programs, they'll allow up to say 50% debt to income ratio, meaning that out of your income, okay, up to 50% of it can actually be used for total debt. And if I may give you a quick example. So for example, if you make $3,000 a month, okay, and the program allows for 50% debt to income ratio, that means that $1,500, okay, is the max total debt that you can have. So if you have a car payment of $300 and you have nothing else, automatically the maximum mortgage payment, including principal, interest, taxes, and insurance, can be no more than $1,300. Okay, because you cannot have more than $1,500 on as a payment. So that could actually throw off your loan, and that's where that example of going shopping right before closing comes in. Because in case you don't know, once you start the mortgage process, most banks will actually set up a monitoring system to make sure that you don't apply for new credit. Meaning that if you go and apply for a new account, the bank will know, even if you don't tell them. Okay. Let's see what else. So unstable employment. If you have 20 different jobs in 20 different areas, that it just creates instability, and that may be an issue. If you cannot meet the minimum down payment requirements, okay, all mortgage programs have a certain requirement of a minimum amount that you have to put in order for the transaction to work. Now, even if that doesn't mean that the money has to come out of your pocket. Okay, most of these programs, a lot of these programs will allow a gift. So if a relative wants to give you the money, if a nonprofit corporation gives you the money, if the government gives you the money, okay, so it doesn't necessarily mean that it has to come out of your pocket. It just means that there may be a minimum amount required to come not from the bank. Okay, and of course, if the appraisal comes in at a lower value than what you're purchasing at, so you're buying a home of $250,000 and the house is valued at $225,000, then that won't work. Okay, at that point, the max that the bank will base their transaction at is the appraised value. So at this point in this example will be $225,000. And that's it for that. So next slide, please. Okay, so hot topics. Cosign debt. If you have, given your signature to buy a car to a relative or a friend, okay, and they own the car, but your name is on that debt, you're responsible for it. It doesn't matter if they are the ones paying it. If you've never, even seen the vehicle, you just gave your signature, you are responsible for it. I see that a lot with vehicles. Okay, the car dealer will tell you it's no big deal, just co-sign for them, it's not going to hurt you. Yeah, it will hurt you in the mortgage process. If you have any type of debt like that, okay, and we'll use the car example, the only way that can probably be excused is if we can prove the last 12 months have been paid by somebody else from a separate account that have nothing to do with you. Okay. And then at that point, it might be possible for the bank to excuse that debt as, not counted towards your debt to income ratios. Okay. Collections. Now, collections are a topic that we can spend hours speaking about, and we just frankly don't have the time right now. But, if you have collections in your credit and you want to start the mortgage process, don't do anything just yet. Don't start negotiating with the collection companies. Don't start paying things off without knowing where you stand. A lot of times, a lot of these programs may not require you to pay off certain collections. Okay. So my advice would be talk to the mortgage loan officer first, get the situation under control there, and then from there determine if something has to be done with collections. Student loans. That's a really hot topic. A lot of us have had student loans, okay? And a lot of us still have student loans. With student loans, no matter what, what arrangements you have made with the bank, with the lender, okay? You may be in deferment, okay? We will still count a minimum of 1% of your total debt towards a payment. The reason for that is because even though you may be in deferment now, okay, you have a 30-year loan on a mortgage. Well, at some point, you will actually start paying on that, and that's going to affect your debt. So, banks the guidelines will require a 1% calculation, and that happens to throw off debt to income ratios a lot. Cash deposits. If you have cash deposits, we cannot verify where the money came from. It could be that, that you borrowed the money from somebody else and you have to pay it back. Well, that creates another debt for you. Okay. There's no paper trail that money can be proven that it was a gift. So that can throw off your loan completely. NSFs, if you've had checks bounced, that's a big no-no. If you go negative on your bank account, okay, you're gonna have to explain that. That doesn't necessarily mean that it's gonna end your chances, but it does mean that you have some explaining to do to make sure that everything's cleared up. Don, you have a question?
We have 5 more minutes.
Okay, yeah, we're almost done, guys. Almost done.
Okay. And
All right.
there's a question there. Is there a way to add money for home improvement or update to the loan package?
So there is a program that allows for that, but most banks will not, don't really mess with it. In general, for first-time home buyers, okay, the answer for that is no. Most banks will not allow any additional funds to set up for an escrow for repairs. Okay. Like I said, there is a program specifically that deals with that, but that program is really outside our scope here.
Okay.
Normally, when repairs are needed, they need to be done before the transaction gets executed. Okay. Okay. So large and unusual deposits. Okay. And withdrawals and transfers, like I said before, no good. If you have tax debt, okay, that's going to come into play, because if you have a payment arrangement with the IRS or anything like that, it's going to be part of your debt to income ratio. So you need to disclose it, because we will find it out. Of course, tax returns, self-employment. If you are self-employed and you have questions about that, ask us. That's what we're here for. Okay, and Cash App, PayPal, Venmo. This is a biggie. Okay, we think it's harmless. But here's the thing: when you're getting money through those apps, that's cash, okay? And again, there's no paper trail. So how can I prove that money wasn't borrowed from a friend of mine for this transaction, okay? In order for me to obtain the home, I can't prove that. So since it's not clear, okay, it becomes a hot topic. It becomes an issue where we cannot actually verify where the money came from, and that could actually put a stop to the whole transaction. Okay, so while you're in this process, please make sure that you stay away from any transaction like that. Okay. Next.
Richard, before you move on,
Yes.
on topic of student loan, there's a question from Wilbur.
Okay.
What if you have proof of a service cancelable loan? Does that help for student loan?
So if you've had proof of what, like an income-based payment?
Proof of service cancelable loan. I'm not sure. I guess if you have proof that it was canceled.
Well, if you have proof that it was canceled, then it is what it is. I mean, if it was canceled, then it's okay. Again, documentation. If we can prove it, okay, we're okay. However, if you've made an arrangement based on your income to make low payments, okay, on those student debt, we can't use that, because an income-based payment plan will actually vary as you make more or less money. Okay, so at that point, we'll use a minimum of 1% of the loan. Okay. You're very
May I
welcome.
clarify?
Please, definitely.
In certain positions, just say state employment, for example,
Uh-huh.
we have service cancelable student loans. So say, for instance, if you're a teacher, if you get in a program, they have it where you can make a set payment for 10 years. After the 10th year, the balance of the loan is canceled. That means you no longer owe it.
Okay,
So that's
right.
how the service cancelable loan works. So I'm wondering, in that particular case, since it is a governmental program and there's all types of documentation about how it works, would something like that be beneficial through the loan process, as opposed to just having your loans? Should we provide all that information if that's available?
Yes, so most definitely. Thank you for the clarification. I'm familiar with the program, like half of what you just said. So that's awesome. Now, if the documentation is there, okay, and it states that this is the payment that you're going to make for the next 10 years, and then it's forgiven, that's the payment that more than likely we'll use. What I would say is, on a situation like that, it's definitely going to be, I would say, let's consider it on a case-by-case basis. Okay. And we're certainly able to find out how that will be looked at beforehand. But I would be lying to you if I told you 100% right now, hey, this is how it's going to be, but more than likely, yes, with that type of arrangement, okay, for 10 years and forgiven, I don't see why we wouldn't be able to use that, especially coming from the government.
I think Dr. Cooper put the specifications in there, in the chat.
Okay.
Yes, she says 120 payments for 10 years, then it's forgiven by the federal government. But as he said, as long as we have documentation, then more than likely it may be acceptable, dependent on the situation. So it's all about documentation.
It is. But let's do this. If you allow me, I'll find out the information and we can actually, update you guys and tell you what the right information is so that we can, clear it up. Okay.
Thank you.
Thank you. Great questions. Thank you. So I guess we're out of time now, I think.
Yeah, I think we're at the end. I think we're at the last slide. One more. And basically here, what I want to say is ask questions. Okay. Like I said at the beginning, don't let everybody's an expert. Don't let them dictate your outcome, because your outcome may be totally different. Okay. We're here to help you. Don't assume that you cannot, qualify. And I'll give you a very personal example. My own father, okay, waited over 20 years to buy his first home because he thought he would never qualify because of one bad payment that he made to a credit union when he was young. And that haunted him for the next 20 years. He missed all that time, and that wasn't even, a consideration. So don't assume. Ask, try. What's the worst that can happen? The worst they can say is no. And with a good loan officer, they'll tell you no, but here's what we need to do to get to yes. Guys, I hope this was of help. Okay. And I hope that the questions were answered, satisfactorily. And of course, if there's any additional questions or any, additional information that you would like, please feel free to ask. That's what we're here for.
Thank you, Richie.
You're very welcome.
Thank you so much, Richie. We certainly appreciate your passion and your enthusiasm to help the dream of home ownership become a reality for all who attended tonight and for all that you work with. In the chat, we have included Richie's contact information. So please take a moment because he sounds like he's definitely someone you want on your side if you're looking to purchase your home or refinance your home. Thank you so much for your questions. I don't see any additional questions in the chat. Next slide, please. If you will, we'd like to ask for you to complete the survey by pointing your camera to the QR code on your screen. Your input is very important to us. This helps us critique our own programs and improve our programs with you in mind. So please point your camera to the QR code, and once you see the pop-up, click on that link to complete your survey.
And Tanya, while they're doing that, we're gonna have words on closing remarks from our chapter president.
Okay.
Hi, good evening, everyone. That was fantastic, and we are so grateful for the participants who are here tonight. Richie and Don, thank you for giving us a great presentation. I'm certain that our participants will find good value in the information shared. And we look forward to having you all provide additional information and hopefully doing business with you in the near future. To the members of the Links who are in attendance, thank you very much for attending. Helen and Tanya and Elizabeth, thank you again for putting together a fantastic presentation. I bid you all a good evening and look forward to the next presentation.
Okay, Tanya, you may continue. You may unmute, Tanya. Mrs.
Thank you.
Thank you.
Well, we'd like to invite you to join us next week. You're in for another treat. You're in for additional powerful information about finding the right realtor. We're going to have our very own Tamara Celeste, who is a Juris Doctorate, and she is going to have a conversation with our own Helen Lurie about buying homes and not shoes. And this book is written by Tamara, and we're looking forward to hearing from Tamara and from Helen Lurie next Thursday, April 15th, 7 p.m. Next slide. Thank you so much again for attending the Discovering the Treasures of Homeownership program. This is our team, our homeownership program team. Next slide. If you'd like to contact us, if you have any additional questions, please contact us at tclinksnts@gmail.com or visit our website at treasurecoastlinksinc.org. Next slide. Again, we thank you and we pray that you have a great evening.
Thank you.
Have a good night.